Hello everyone. So in this video, I'll give you a brief of the state of the Indian economy. So being an economist student, you should be aware of all these things. So starting with the Monetary Policy Committee, which is supposed to meet in February, maybe 5 to 7 or 6 to 7, 5 to 6 or 6 to 7. So they decide the policy repo rate, what the policy repo rate should be. And repo, you must be aware of what repo rate is. It's the rate at which the central bank, that is RBI, lends to commercial banks, where this against the collateral of government securities. So this is conducted under liquidity adjustment facility. Now, so currently the repo rate is 6.5%. In the last meeting, two external members suggested that repo rate should be reduced, whereas the majority, four of them, were of the opinion that the repo rate should remain 6.5% only. So the repo rate was not changed. The primary purpose of RBI, the Monetary Policy Committee, which consists of 6 members, 3 are external members and 3 are the members of RBI, and the chairman is the governor of RBI. So in case of a division, suppose voting take place on the repo rate, the equal votes are being given to both the opposite scenarios, then the decision of the governor prevails. Now look at how the monetary policy transmission mechanism works. The Monetary Policy Committee, which is constituted by RBI, this suppose reduces the repo rate. Now it becomes cheaper for the commercial banks to borrow money from the RBI. So the commercial banks borrow more, and now they reduce the interest rate that is being charged to the general public. So this would lead to more increase in the money supply and hence higher investment and expenditure, so increasing aggregate demand in the economy. Okay, so now there are a lot of factors, but the thing is, when repo rate is reduced and there's an increase in the aggregate demand, this leads to inflation as well. So there's a trade-off between inflation and growth. So if the government is focusing more on growth, it would lead to higher inflation as well. So this is the trade-off that RBI needs to manage. Okay, so now given this scenario, it is expected in the next meeting the repo rate would remain at 6.5 only, because there are different reasons for this. Firstly, in US, the unemployment rate has been close to 4.1%, and the inflation has increased in US. So inflation is close to 2.7% in US, which means even US won't have any tendency to reduce the interest rate, because they reduce the interest rate, the same process will follow. Interest rate reduces, aggregate demand increases, and hence this would lead to more inflation. Although output would also increase, but it would lead to more inflation, which US won't prefer. So they will stick to, so the following studies, a lot of studies have mentioned that they were expecting 2 policy cuts in the coming year, but now they will have only 1 policy cut, 1 interest rate cut throughout the year. So since the interest rate in US will remain higher, so the RBI doesn't have any incentive to reduce the interest rate as well, because if RBI reduces the interest rate, then more and more of the funds, the capital outflows that we call, will move to, there would be capital outflows, which is also known as capital flight. Capital flight is a sudden increase in the amount which goes from the Indian stock markets to abroad. So this would lead to stock market crash. So you would have already observed the stock market prices are falling. Okay, so this is how the scenario prevails. Now I'll discuss in depth the other scenarios. Now, if you're talking about the GDP, India's GDP So if I tell you in rupees, 326 lakh crore rupees. So this is nominal GDP. Whereas if we talk about real GDP, it is close to 186 lakh crores. Now if you want to check how many trillion dollars GDP is this, you just need to divide this by the current prevailing. So $1 equals to suppose rupees 85. So you divide this by 85, you'll get the GDP of India, nominal GDP of India in trillion dollars. Similarly for China, it is close to 17.7 trillion dollars. Whereas for USA, it is close to 26 or 27 trillion dollars. And for India, it is close to 3.82 trillion dollars. So our target is to have a $5 trillion economy. Okay. Now talking about the foreign exchange reserves, India has 700 billion foreign exchange reserves. So India became the fourth country after China, Japan and Switzerland to have foreign exchange reserves of more than $700 billion. And since RBI manages the external and foreign exchange reserves of India, so RBI is intervening in the foreign exchange market so that rupee does not depreciate by much. And because of this, the foreign exchange reserves are left. The foreign exchange reserve which are left is 640 billion only, because RBI is supplying the dollars so that the rupee does not depreciate by much. So this is also a thing that RBI needs to take into consideration. Then the stock market, you should know that India has become the fourth largest stock market in the world. So it has actually, the share has been increased and it has beaten Hong Kong in this. Now, since there are a lot of, we'll discuss the domestic factors more. Now, since inflation in India has eased, it was 5.48% in November. In December, it is 5.22%, which has reduced. Similarly, CPI. So the inflation targeting is on CPI combined. So CPI is Consumer Price Index, and combined this takes into consideration the rural and the urban sector as well. The food and beverage, this constitute a weightage of 45.86%. So which means a majority of the income of the individual is spent on food and beverages only. The consumer price index consists of this. So this is a major component. And the inflation of this was 7.69% in December and 8.2% in November. So this has also fallen. Perishable and vegetables, the inflation rate for this particular group is 26.56%, whereas in November it was 29%. Now an important topic, core inflation. What is core inflation? This is headline inflation. Core inflation is nothing but headline inflation when we are removing two elements. First is food and the second is fuel. So if you are removing these two things from headline inflation, you will get the core inflation. Inflation of food and fuel. The core inflation, why do we find this? Because food and fuel inflation is very volatile. So this gives us a more stable inflation, how things are working, because food and fuel are very volatile. Now, since US has recently imposed sanctions on Russian oil as well, so the price of Brent crude has already reached $80 per barrel. And this is a study which states for every $10 per barrel increase in the price of Brent crude, the inflation in India would increase by 0.5 percentage points. So this concept is called imported inflation, because we are importing a significant amount So basically we are importing inflation from the other countries. Okay, since 85% of the oil needs of India is met from imports. So if the price of imports increases, we are basically importing inflation. Now, over the past 1 or 2 weeks, what we can see is there are net FPI outflows which is happening in the Indian economy. Where in this is happening in the equity markets, whereas the foreign investors are investing in debt market. So that is why the market is falling. And the domestic institutional investors, they are investing heavily in the equity and the bond markets, both. So because it is expected these sanctions and the global uncertainties, the 10-year bond yield on government securities has increased to 6.85%, which means if the government is borrowing for 10 years, it is supposed to pay 6.85% every year. Okay, so we have completed this. Now suppose, now if you're talking about the banking sector, for the scheduled commercial banks, the gross NPA has fallen to 2.7%, which is at a 13-year low, and the net NPA has fallen to 0.57% of the total advances, which is also very low. So how the provisioning, so gross NPA equals to provisioning plus net NPA. So the provisioning has also been increased because this gap is higher, close to 2.13%. Now the main question arises, because you all must have heard about rupee touching the lowest to rupees 86 point something. So the question arises, why is rupee depreciating? So there are certain factors which are leading to depreciation of rupee. Global factors. First is the US economy. It is more resilient now. So if it is more resilient, so unemployment rate is falling, growth rate is increasing. So the investors would prefer to invest in rupee, in the US economy itself, because it is more, although the return would be less, but it is more stable and resilient. And then there are different sanctions being imposed, which leads to more geopolitical tensions. So US is considered as a safe haven for investing money in these scenarios. There are geopolitical tensions as well. Okay, so these are the, and then the sanctions which are being imposed on Russia, that also influences the scenario. Now, from the perspective of domestic factors, so the corporate earnings are expected to be low. Although the agriculture sector, the net sown area under Rabi crops has been higher as compared to the previous year. So this is a positive news, but there are other domestic factors as well. So inflation already is close to 5.22%, which is in the range. So the inflation targeting, you should know that inflation targeting range, it is 2 to 6%, which is 4 plus minus 2%. So I'll make a separate video on how inflation targeting is done. Okay, now the domestic factors are, and there is RBI can intervene up to a certain limit only, because initially there was $700 billion reserves. Now it has reduced to $640 billion. So RBI also cannot intervene throughout. Now the crude oil prices are rising. So this would also impact the domestic factors. So for all of you who are aware of what J curve is, so this can show why depreciation is not always good. So because depreciation, I'll tell you what depreciation is. It refers to the fall in the value of the domestic currency with respect to the other currency which is happening due to market forces. So suppose $1 was rupees 80. Now if $1 becomes rupees 90, so our goods are becoming cheaper. This would mean the exports would increase. But the Jacob scenario states that the cost of imports is also increasing. And since India wants to be a part of global supply chains, so if the cost of imports is increasing, the cost to produce the good would also increase, and this would in turn hamper the export potential, because we will lose the relative or comparative advantage. Okay, so being an economics student, you must be aware of these things. Even if you're not an economics student, you must be aware of these things about what is happening in the Indian economy currently. So I'll keep you updating about these things. So that's it for today. Thank you.